Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation, bringing you part 3 of a 4-part series where I take a very in-depth look at the S&P 500, one stock at a time, utilizing the FastGraphs Fundamentals Analyzer software tool. So in each of those videos, I'm doing somewhere around 30 stocks that I thought were very interesting, that provided super important lessons in valuation, and also importantly, how it is a market of stocks, not a stock market. Now, parts 1 and part 2 are also linked at the bottom of this video in case you missed them. So you can review the whole series by just going to the various links. But in today's video, I'm going to cover some pretty high profile names, and some names that some of you may not be familiar with. But there's some really interesting dynamics. And one of the things I'm really trying to illustrate here is just how different each stock is, regardless whether the market's up, down, or sideways. There's always going to be stocks that are trading at fair value. There are going to be stocks that are undervalued in the market. There are going to be stocks that are overvalued. Now, in a major bull market like we're in, you're going to end up finding more overvalued stocks than undervalued. And if you run into a major bear market, you're going to typically find more undervalued stocks than overvalued. But the point is, it is a market of stocks, not a stock market. And what that simply means is every company is different, and you're going to be much better served as an investor to think about the individual holdings. Like I like to say, mind your owned, OWNED, mind your owned businesses, because that's what you want to pay attention to more than the market. So let's go through some examples. That's going to be high level. I'm going to be looking at these companies on a very high level basis, just kind of skimming the surface, if you will. But I think you're going to see some interesting names here and some interesting dynamics on these stocks. So let's go ahead and get into the FastGraph tool and look at today's choices. This will be my Standard & Poor's Value Portfolio 3. And the very first name we're going to look at here is Nike. And so let's go ahead and get right into Nike and look at what Nike looks like today. Now, we've also, before I go in further, we've created a new version or an improved enhancement of our version of FastGraphs where we create this summary page, which gives you all this information about the company in one single spot. So those of you who are subscribers, I hope you're utilizing that. But for today's video, we're just going to look at the historical graphs. So let me start with Nike. And first thing that really strikes me when I look at this stock is the idea that the stock has been overvalued. Now, by the way, I like to see the company between the orange line or the blue line. I consider the blue line, but this is what we call the normal PE. And this is the valuation that the market has most commonly applied over whatever time frame I'm graphing. And I can graph all these different time frames. So I'm using the max graph here, which goes starting in May of 05, going back that far. If Nike has a May fiscal year, I've got all the results. So my normal PE here is 24. So anywhere in this blue line, that would be a PE of 24. But if I shorten the time frame, now the normal PE over this time frame is 29. So if you look at this, you can kind of see that. You can see that the valuation even got higher when you look at these later years. There was a period of time where the valuation was below the blue line all the way up through probably 2012 or 2013. Then we start seeing this excessive valuation really in 2018. So if I draw an 8-year graph, the PE ratio, the normal PE is even going to be higher. Now, how do you use this? A lot of people, I think, are confused about that. This is simply giving you a perspective of how the market has been valuing a company over whatever time frame you're looking at. So in more recent years, we know that the market's been putting a very high multiple, 33 times earnings on that. And that ends up being an earnings yield that's simply subpar, in my opinion. But I also want you to notice something else. These high valuations are during a time when Nike didn't even have any growth. It only had growth of less than 1%. And the fair value ratio, as a result of that low growth rate, calculates only at a PE of 10. Okay, that would be the orange line on this graph. So now when I go to forecasting, if I want to look to the future of Nike, and I look at the normal 15 PE, remember we're using fair value as 10, 10 would be somewhere down in here. And that would indicate that Nike would still be delivering losses, assuming the market was acting rational. Now, if I looked at the normal multiple of Nike, where we had this 33 multiple, then you would see a much higher net result. But my point is this, and I want you to basically think about this as I go through these names. How is Nike being valued so highly, higher than it historically has been valued? And with all these high valuations, when the actual operating results have been really poor. So again, if I go to like 10 years here, we've had a period where Nike's had zero growth, and yet the market's applying these astounding valuations. And once the market kind of came to its senses, I'm just picking a couple dots here, you can see that the results were 21% annualized losses over the last 3.5 years or so. Okay, valuation matters, and it matters a lot. So whether or not you like Nike or not, and whether it's been a great business or not, recently it's stumbling. Now, analysts do think the stock is going to recover a little bit, but the market is still pricing that it's at a very high valuation. So I'm obviously not a fan of Nike here. I think Nike's still too expensive. And I did a video a couple of years ago that said, Nike, just do it, just sell it. But the stock continued to rise for a couple of years after that, even though the fundamentals never justified it. Don't discount the fact that the market can be irrational at times. And believe in fundamentals more than stock price action is part of that message. Now, the next stock we're going to look at here is one I've been asked to review, by the way, is Norfolk Southern. Okay, and Norfolk Southern is obviously a major railroad. And you can see that, again, it tracked earnings very nicely for most of the time. All right. But then the dividend has been very consistent. That's the gold line on the graph. So when I take this area below the gold line, which is the payout ratio, when I stack it on top of the gold line, then you can see the dividends look like they were rising and falling. They weren't. This is the picture of the dividends here. But it just points out you get capital appreciation, which is the price moving from point A to point B, plus you get the dividend income. Okay, and the bottom line is, once it got really highly valued coming out of COVID, and once again, you have 3, 4, 5 years here where you get a lot of volatility and not much in results. In other words, I like to look for companies that you can buy and hold. And Norfolk Southern has been one, if you were going to make money in this stock over the last 4 or 5 years, you really had to trade it, buy it and sell it and be right. And now that we do look like we got good growth coming forward. If we were looking at the normal multiple of 20 times earnings, it could be a buy here. But I think that's too high a valuation to apply to a stock that's only expected to grow at 11%. But it could get a premium valuation at that point. So if I'm looking at it from the last several years here, let's say just the most recent years, a 19 or 20 multiple is not uncommon on the stock over these years. All right, so and it could be, you could argue it's trading a little below that, but again, you're buying the stock at a point where your risk is extended beyond what you should be taking as an investor. The next stock we're going to look at is NetApp, or Network Appliances it used to be called, and it's a technology, hardware, storage, and peripherals. And once again, you see the power of earnings. You see a period back here going back to 2004 where the stock was overvalued, coming into the recession. That created a period where you'd have lost almost half your money holding it here, even though the company's earnings were doing well. Then it got inexpensive, and even though earnings began to falter here and they started paying a dividend, as Fast Graph instantly tells you, in 2014, you can see that as it tracked earnings, you could have made a real nice rate of return holding this stock. But when the stock got overvalued in 2011, once again, you end up facing a period where you have dead money for several years. Valuation matters, and it matters a lot. Yes, I'm going to keep repeating that as I go through these videos for those of you who seem to find that being funny. But the point I want you to see here is how when valuation gets overvalued, the market always reverts to the mean. And a lot of times it'll just be a catalyst, like a weakening of earnings here. Again, Network Appliances was very profitable during these 3 years, or these 2 years here, but earnings did drop, and they have an April fiscal year, by the way. Earnings did drop for their fiscal year ending April 30th, 2020, and that led to a rather steep drop in stock price during that period of time. Okay, because again, if you're going to invest in a stock, ultimately the price is going to track earnings in some form or fashion. It's going to get out of whack occasionally because in the short run, emotions determine market price. But in the long run, it's the fundamentals. You can see since going back to April of 2015, how it really tracked earnings. And again, it gets overvalued, it comes back, gets undervalued, it comes back. So that's network appliance. Next one we're going to look at is Nvidia. And this is the hottest stock maybe in the market now. But again, I want to make some points here about Nvidia. If you look at Nvidia prior to when the AI craze really took off, we had really good growth because in 2016 we had this huge growth rate. But if I call out a couple of more years, meaning CULL, then there was a time where it still grew at a very attractive 17%, but look at the cyclicality during that period of time. But then as I moved through, once earnings began to surge, the stock price began to surge. And it surges beyond what the fundamentals justified. Okay, and it got high, and then once it got too high, it started to move sideways a little bit, as you'll notice there. And then again, once it got too high, and then we had a little faltering of earnings, we had this collapse in the stock price. So it's so important to keep up with the fundamentals. Now we've got very strong fundamentals, and we're using Peter Lynch's formula of P equals growth rate for growth stocks. So here we're using a fair value PE of 52, which is a good fair valuation reference, as you can see, because the stock clearly tracked that because the earnings growth was 51.88 or 52. Okay, but now if I'm investing, I'm learning from the past, but I'm investing in the future growth is expected to be about half as fast, which means it would still be a profitable investment if you bought it today, but it would obviously be a more profitable investment had you bought it when the stock was, trading at one of these lower valuations. Like here, you could buy it and you would get a lot more bang for your buck rather than buying it when it's expensive. So that's Nvidia. The next stock on the list is going to be NVR Inc. And again, once again, you see a stock whose price tracks earnings. You see these periods of high and low valuation. The company's got good growth prospects, does not pay a dividend. You see that instantly on Fast Graph. There's no gold line on the graph, and there's no light green shaded area. And again, we see a point where the market, because we had a good earnings year, which was only good, 9% growth, but coming off a negative year. But now we're facing a year where analysts expect, this is a December fiscal year, an 18% drop in earnings. And so it's the weight of overvaluation that caused this drop. Almost 27%, pure, and it's basically almost a 47% annualized loss because it simply got overvalued and fundamentals faltered a little bit. Now, looking to the future on this one, it's probably reasonably in line, but we are expecting some more bad quarters. And analysts have been lowering the estimate on this stock for 2025. Analysts, only 6 of them, and we've had the same thing going for 2026 and 27, but we do have an excellent scorecard, which means once analysts settle on a number here, they tend to get it right on NVR. But it's pure growth, and you're simply speculating on the price movement. You've got no dividend income to help you smooth out some of the volatility, if you will. The next one here is NXP Semiconductor, and a quick glance at Fast Graphs. I see they started paying a dividend in 2018. I see that they've steadily raised that dividend every year, which is a real good sign. It offers almost a 2% yield now. The stock tracks earnings beautifully. It came in COVID. Of course, we had the flash crash. Then we had earnings improving. The stock got really strong, and then it started to go sideways, and then we started having some down earnings, and we started seeing the price drop precipitously, or rather precipitous. Not too bad here. If you go from kind of peak to trough here, we had about a 20% drop in value. But again, a lot of volatility. Look how jagged that price line is. And they say the market's forward looking. Well, here the market was looking ahead with some pretty good numbers, but then now we're facing some down years. And why the stock got overvalued here is anybody's guess. But as the reality of the 2 or 3 years of negative earnings set in, then the stock price faltered again. Looking at the future, again, we're facing a year of weak expectation, and then we're facing a couple of years of really strong growth. So the key would be here, hopefully to catch it when it's below the orange line. If you're looking 2, 3, 4 years out, like I like to look out, then that might have been a great time. This would have been a great time to buy NVR right here in May of 2025 when the PE was 14. It's not bad now, it's 17, but obviously it's better the cheaper you can buy it. The next stock on the list here is Old Dominion Freight Lines. And I find this one really interesting. We've had a really good growth story here. And again, if I look at past history and look at when the company did really well, and go ahead and scroll back where the company had this really strong earnings growth over 20%, look how perfectly the stock price tracked that. And we're using a 22 PE here as fair value because that's the growth rate. But even with a 22 PE, we started seeing these PEs get up into the high 30s, and then it crashed back down. But then as I move forward again, fundamentals deteriorate and the stock collapses, but yet it's still above what it should be. And then once we get these high valuations with weak earnings, we've got a lot of volatility and really the stock's going nowhere. Even if you bought it here and held it to now, your rate of return would be a negative rate of return. And in the meantime, you would have to be intestinal fortitude to go through all of that volatility that the stock went through during that time. Moving on, we've got Oneok, which is a oil and gas storage and transportation company, has a very strong dividend yield, almost 5%. With a stock like this, you really want to look at cash flows and see that the cash flows are covering the dividend, and they do cover the dividend, meaning the orange line is above the gold line. Okay, I'm not so much concerned about price here as I am, do I have adequate dividend coverage? And of course, the acid test on that with a dividend-paying stock would always be the free cash flow to equity. And there we see a little bit of trouble, but that's because these companies can be capital intensive at times. And you want to take that into consideration. Operating cash flow seems to indicate that the company's capable of paying the dividends, but there were times when they were paying out over 100% of their profits, but not 100% of their cash flow. That's the important issue there. On Semiconductor is a pure growth stock, no dividends. You can see it's volatile. It has ends up with an average growth rate there, but if I change the time frame, now the growth rate's 9%. Get rid of another year, now the growth rate goes up to 14%. So I want you, that's why it makes fast graphs so powerful, is you can analyze all these different times. But when you put price on the graph, you see almost this perfect long-term correlation between price and operating results. When earnings were surging, the price surged. When earnings were collapsing, the price collapsed. And it did get very highly valued in August and September of 2023, but then with earnings collapsing for those 3 years. But once again, this company never showed a loss. It was still a profitable company, but you can see how the market price really reacted to the earnings growth. Now, looking forward, if you're willing to hold it for maybe 2 or 3 more years, you could end up having a nice investment here. And the company has modest debt, but it's only BB plus rated. It's not an investment grade company. I do want to make that clear. And it's all about trying to make capital appreciation or profit. There's no dividend income again to help you out if anything goes sour. The next stock on the list is Oracle. Oracle is a really powerful software company, and it ranks up there with the Microsofts of the world. And it's had almost a perfect relationship with its earnings. Now, the earnings have averaged about almost 13% over this time frame. And the stock, that gives it a 15 PE fair value. You could just look how spot on that is. Look how the 15 multiple gave you a great benchmark. Now, you could buy it when it was trading at a higher PE, and even when it was traded at a lower PE, you could still make almost 10% a year because of the growth and the consistent growth of the company. But it does throw out the occasional down year, and when that happens, you see that the price tends to falter during those time frames. That's why it's so important to focus on fundamentals more than stock price. But then we got pretty highly valued in 2021, and it reverted to the mean. And then we've had this period with AI craze and all this stuff where the stock is really rallying, and then it fell pretty sharply during all the political football stuff that was going on. But it's rallied pretty strongly since. But I do consider this to be a great business that's overvalued at this point in time. But you can see the impact and the importance of fundamentals, also the importance of valuation as you look at Oracle. This next stock is Paramount Global, and this is a really interesting story. I have no idea. Something must have been going on here. I'd have to look deep into that. But you can see this gigantic rise coming out of COVID, but yet the company's fundamentals kept faltering, and so the stock ended up collapsing, even from buying it, which would have been theoretically at fair value. But here's where fair value is only fair value if the earnings are strong and growing. If the earnings are collapsing, even buying a stock at a good valuation where you could have bought it here at a PE of 10, which it was way below a normal 15 PE. But because earnings collapsed, the stock collapsed, you can notice that they also cut their dividend. So there's always going to be a lot of shenanigans, if you will, going on with stock price. But they don't ring a bell at tops of markets or bottoms of markets. You never know what the market's going to look like or what the market's going to do tomorrow. But the fundamentals, you can get good, solid information on the fundamentals and get price off the graph. And you can clearly see that this stock was growing pretty strongly coming out of the recession up through 2018. And then now we've been in this, we'll call it abyss of profitability going on for the last 4, 5, 6 years, whatever that counts. The next here is Paycom Software. Now, this company started paying a little dividend here. They've already cut it, but it's got a pretty strong growth record. Again, if I shorten the time frame, it's got pretty consistent growth. When I put weekly closing stock prices, this is where the picture gets interesting. The market can get overly irrationally exuberant, as Alan Greenspan once called it. But when you're dealing in this, even though nothing really bad happened to the fundamentals, earnings growth did slow down from strong double-digit to single-digit. And, of course, the stock price from these high, and I'm not trying to hit peaks here, from these high valuations or bottoms, we see these, it drops 56% in value. And then once it got really cheap into fair value here, all of a sudden it became a good investment again. Same company, no change in earnings. The only thing that was different was the valuation the market was willing to pay. And I always tell the joke about what is the definition of appreciation. It's when others, in this case the market, appreciates a stock way more than I do. And by just looking at this graph, I'm looking at extremely high risk. Even back here pre-COVID or just before COVID, you could have owned this stock for a lot of years and actually lost money, even though you went through all this volatility during that time frame. Valuation matters, and it matters a lot. And the market is an individual market of stocks, not a one-size-fits-all. Now we're looking at PG&E, which is an electric utility. They've slashed their dividend. They hit a wall here on earnings, and you see the stock price collapse. And now it's beginning to grow again. And we're looking at forecasting. It's paying a very modest dividend. It could actually be a good investment for the next 2 or 3 years here if everything comes out like the analysts expect. The general scorecard is pretty good. So even when it was not doing well, it looks like the analysts were getting the earnings forecast pretty spot on with this stock. Okay, and it's only double B rated, again, not investment grade. So moving on, the next stock here is Pepsi. I did a full video on Pepsi, or a 2-minute drill on Pepsi. If you look at Pepsi, one thing that you need to recognize is the blue line. I call this a blue line company. This is a powerful brand and well-recognized brand, and it typically trades at a premium value of somewhere in the 20 multiple or higher. The blue line on this graph is just, we'll call it a 21 multiple. It's 20.86. So if the stock price is touching that blue line, it's around a 20, 21 multiple. But generally speaking, it's traded at a 21 multiple until we hit the recession of 08 and 09. And then for about 4 or 5 years, you could have bought Pepsi at an attractive price. And even after today's collapse, if you'd have bought it when the price was sound, when it was trading below 15 times earnings, it's still trading at a higher PE. You'd have made 8% a year and received a nice dividend. And again, the point of note here is when you look at this, the most consistent line is the dividend line. They've raised their dividend every single year. The earnings line is less consistent, but still the second most consistent. And then, of course, the most nervous line, if you will, is the price line, where the volatility of stock prices is something you're always going to deal with, and you never know when it's going to zig or when it's going to zag. Pepsi is starting to look very attractive again for those who are looking for income. You got a 4% dividend yield. It's A+ rated. It does have a little more debt than I like, but the company's been making acquisitions and doing things to reposition their business for the future. And so we're looking at a stock now that's at a 15 multiple. It would give you a modest rate of return. But if it traded at its normal 20-ish multiple, this is 25. So what I'm going to do here, I'm going to go to the normal here, and I'm going to draw it more in line with what I would consider a fair multiple. Well, there's the 21 multiple I talked about. So if it trades at that kind of multiple, you could actually make 17 or 8% a year. All right, again, valuation. It always comes down to valuation, and it always comes down to fundamentals. and how fast the fundamentals grow. Pepsi only grows at about 5 or 6% a year. It's only forecast to grow at about 4% going forward. But the point is, the market gives the brand a lot of value, and that's why it tends to trade at a premium. It's obviously a high visible, profitable stock. Now, the next is Pfizer. Of course, we went through COVID. They were selling all the vaccines, and their earnings really surged, and you could see the stock price surge. But then earnings collapsed in 2023, and then they rose again in 2024, but the market price hasn't really reacted to that. But analysts don't expect much from Pfizer going forward. We actually expect no growth for the next 3 years. And we expect negative growth, about 2% growth and negative growth. If Pfizer did sell at a 15 PE, you could make a lot of money just because you could buy the stock today at half of that, at a 7.5 PE. The normal multiple for these recent years has been about 12 times earnings. And again, if you look at it using this drop down here, the multiple got down to as low as the normal multiple, as low as 10. So what you're doing here, you're buying a high yield, 7.5% dividend yield, modest debt, A-rated company with virtually no growth. So you would be buying this for the income. Now, I do want you to notice, excluding the recession of 08 and 09, the stock has generally grown its dividend every single year. And so if you buy it at an attractive enough price, and when you're offering a dividend yield, see, this dividend yield line is what really it tells the story. Because here you can see that when the price got very low, that's when the dividend yield got high. Back during the Great Recession, we had a 7% dividend yield. All right, and again, that dividend grew every year. And we've got that high dividend yield now. So when the value's low, the dividend yield is highest. And so if you're looking for income, Pfizer could be an attractive yield stock for you now, but you got to face the fact that you're not going to see a whole lot of growth. Now, they can surprise you either way. Next stock on the list here is Parker Hannifin, a really consistent company whose stock price tended to follow earnings at a 15 multiple very closely. Then it got overvalued, a lot of volatility, but it started to really come down, and then now it's rallied back up again. It's simply a great business, investment grade, triple B plus rated, with very modest debt, a modest dividend yield because of the high price. Once again, the dividend yield is low because the price is high. So we're looking at a stock here that is not investable today, but if you ever find it when it is trading at a reasonable price, even if you just hold it where it stays in value, you can make very nice rates of return. Of course, if it happens the market treats you nicely and you get overvalued, your rate of return shoots up to like 23% a year. But again, a great company, investment grade, like the debt levels. The dividend yield is too low because the price is too high and the valuation is overvalued. Packaging Corp of America, once again, we see how price tracks earnings, whether earnings go up, down, or sideways. The stock got overvalued. It's correcting. I would consider this stock still overvalued today. Just looking at it here, it's triple B rated, has very good debt. It does offer a 2.5% dividend yield. I think the message here is, statistically, by the numbers, it looks good. But when you look at the company based on valuation, as indicated by its earnings growth, you're looking at an overvalued stock that could end up disappointing you over the next 2 or 3 years in terms of performance if it traded at or near the 15 PE or the orange line. And it is a quasi-cyclical, so you also would have to take that into consideration. The next stock on the list here is Prologis. Again, it's an industrial REIT. It's had some pretty good performance historically. I'm talking about operating results and a pretty high payout ratio. It does offer a 3.6% dividend. It's trading below what the market is normally priced it at, but then you have to ask yourself, are you willing to pay that premium valuation to buy the stock? And if you are, it could end up being a good investment with a nice yield. But again, you have to ask yourself, is there risk? Now, once it got really overvalued back here in January of 2021, a great company turned into be a horrible investment, and it did have a couple of down years of adjusted funds from operations. So this is a REIT, so we're looking at it from AFFO, not earnings in this case. And that's, again, another story about the individual nature of stocks. Pentair is another semi-cyclical whose stock price tends to track earnings. We get periods of strong growth. The market gets irrationally exuberant. Then we get a little bit of disappointment. Growth falls from 36% to 8%. The stock craters during that period of time, but gets into a position where you can buy it at a very attractive value. And now we're dealing with a very high valuation here. And looking forward, it does expect it to grow at a pretty strong rate of 9% per year, but you're really paying up to buy the stock. And even if you look at its normal PE here, it would be slightly above what fair value. That's a normal PE of 20, which again, I would say is kind of rich for the stock, but that's only for those last years. Normally, the normal PE is below 15. And again, I'm analyzing that by looking at the fast graph and evaluating the time. The next stock on the list here is Pool Corp, which I think they distribute pool supplies, if I'm not mistaken. I don't really know this, of swimming pool supplies and equipment. So a lot of people have swimming pools, but again, had pretty good growth. But then we hit this area here for the last 3 years where earnings have been faltering, and this high valuation then all of a sudden disappears. And so even if you're buying it not at the peak, but here's a 3 or 4 year period where you end up losing money every year. Pays a modest dividend, has modest debt, it's not rated by Standard & Poor's. But again, you want to buy stocks when you can participate in the value. Now here's PPG Industries. It's a specialty chemicals company. Very inconsistent growth. It averages only 7% a year. Short in the time frame, the growth is only 4% a year, yet the market puts a 19 multiple on the stock. Going forward, they expect it to grow around 6.75% a year. That would, a normal multiple of 21 would make this a very attractive investment. But my problem with that is I don't see where that kind of growth warrants the high multiple. But yet it has, and it has in the past. But keep in mind that multiple disappeared over the last 2 years here. Now we're looking at the stock trading at a 14.5 PE, which is more normal, let's call it. Okay, the next stock on the list would be Quanta Services, symbol PWR. It's construction and engineering. And once again, if we look at this stock over the long run, it started paying a dividend very modestly with a very low payout ratio in 2019. They have put out a pretty good dividend record. They've grown it pretty nicely, but it has virtually no yield, 0.12%, less than 0.2%. But the stock has tracked earnings growth in recent years, and it did get very inexpensive pre-COVID for really a long period. Here's a period of time where this is how the market can be so exasperating. Let's just look at it from this period. I'm picking this on purpose. It had negative rate of return, but yet the company's earnings grew 43% on top of a 30% growth rate, and then 19% and 15%. And yet the stock went negative 11% annualized over that 2.5 year period. And then all of a sudden, the market realized, hey, even though the company's earnings slowed down a little, it still grew at double-digit rates. And now all of a sudden, just boom, now for the next 5 or 6 years or 4 or 5 years, the market's generating almost 58% annualized rate of return. But the stock is clearly overvalued, and it was correcting early this year, and then now it's ran to the top again. I consider it an overvalued selection as well. PayPal is one of the great stories about valuation. The market loved this stock when it first went public, and it went public in June, I guess it was, or July of 2015. The market put a premium valuation of almost 30 times earnings or higher for several years. It went through COVID with no damage, a slight drop in the price, but then the price skyrocketed up to insane levels. The PE got into the 70s, which was just absolutely astronomical. And then all of a sudden, we see this correction to fair value of 75%. So anyone who bought this stock back when the valuation was high could have held it for years thinking they were making money, and then all of a sudden now they've got annualized loss. They talked about the lost decade years back, and this is a lost 7 or 8 year period strictly from a company who had pretty decent operating performance. I mean, look at the earnings of the company. They have one down year in 2022. The company actually earned pretty good money here. Again, if I bring the scroll bar back, you had a business that was generating 16% earnings growth, a couple of down years, but the problem is the market price was trading in this nosebleed stratosphere here, and now it's come back to reality. So valuation does matter, and it matters a lot. And you can see the dangers of owning stocks and investing in stocks when they're massively overvalued. It doesn't take much of a catalyst to bring those stocks down to reality. We're looking at Qualcomm here, and again, high period of high valuation turned a pretty good performing business into a pretty lousy investment. Then it tracked earnings pretty good, but there's a lot of cyclicality. Here we have several years in a row of negative earnings, and we have several years in a row of negative performance, and at times it got really bad. Then the stock, the business catches fire, and the stock, of course, reacts, but then it collapses again, and the stock price once again collapses. This kind of volatility, in my experience, is a lot more than most people can handle. Then it got overvalued again, coming into May of 2024, we'll call it a year ago, and then since that time, the stock has lost a fourth of its money over that period of time. Again, a lot of it valuation, some of it fundamental values. Fundamentals and valuation are the two things you want to look at. The next stock on the list is Royal Caribbean. Of course, they had to shut down during COVID. The stock price did collapse, but it stayed healthy even though the company was actually losing money for 3 years in a row. And then once they started making money again, the stock rallied. And now we're looking at the stock that's got about an 18% forecast growth rate. Could probably buy this stock here today and make a decent rate of return going out for the next 2 or 3 years if it traded at a P equals growth rate. If it only traded at, say, a 14 or 15, which it could do, you'd still be looking at about 7% annualized rate of return. So again, this is a stock who you would have to be forgetting about its history from COVID and be focusing on the cruise line and cruise industry and what it's going to do over the next 2 or 3 years. The next one on the list is Regeneron Pharmaceuticals. Again, a non-dividend paying stock. I'll shorten the time frame where there's a lot of profitability. The stock is always reacting to fundamentals, and that's the point I want to get at. And sometimes the fundamentals just simply don't make any sense, and then they get their comeuppance. But at other times, it does make sense. But the key is this the kind of company that you want to invest in as a long-term investor? And I don't really think so, because if we're looking at forecasting earnings, they do have a good record, a good analyst scorecard. So saying that, we're looking at a real bad year this year for 2025, followed by a couple of good years, and how the market and how the stock price is going to react to that is yet to be determined. Moving on, we've got Ralph Lauren, the apparel and accessories and luxury goods company. And once again, we see periods of high valuation that turned out to be long, extended periods of really poor performance. Even if you look at high valuation here, you really don't make any money for 2 or 3 years. And then you had a period where the price do real well for you for a couple of years. But then that got to the point of being so overvalued that over the next 6, 7, 8 years, you lost money again. So this is not a buy and hold. And also notice the inconsistency of their dividend, where they've cut their dividend several times in recent history. And again, I consider the stock overvalued today. So I'm not really a fan of investing in Ralph Lauren today. I'm not really almost at any time, to be honest with you. Here's ResMed, a healthcare equipment company. And once again, we see what high valuation really leads to. And by the way, I want to make a point. See if I can scroll time out of here again. During this period of time, when the stock was trading at these valuations, you couldn't tell any investors that this was not a great stock. When the stock was doing this, everybody loved it. It was fabulous. But then as time marched on, all of a sudden it hits that peak value, whatever stimulates that. And then we didn't even have any real damage in earnings. We continued to get good earnings growth, but the weight of excessive valuation created a period here where you had pretty significant annualized losses. And now it's growing again, and the stock has rallied, but again, rallied to a level that's far beyond what I think the earnings or the operating results justify. And I would expect losses over the next 3 or 4 years on ResMed. Next, moving on, we got Rockwell Automation. Again, a premium valued company, A-rated stock, 38% debt. You can see how, like almost similar to Pepsi, the market always put a premium valuation, but then the valuation got even above that premium level. And even now, you're making a 5 or 6% return. You're going to eat all this volatility along the way. I consider the stock really overvalued today. But again, it's looking at the individual nature of the stocks in the market. Here we have Revvity, I guess it's called, and we see how the price tracked earnings, and we had the surge in earnings, surge in price, drop in earnings, drop in price, and now we're looking at a stock that's expensive but is expected to generate good earnings. I wouldn't be mind buying a stock if it got back down to the quote-unquote fair value reference line, which is 15 times earnings, but I wouldn't want to buy it before then. And here's the mighty Starbucks. It's been written about and talked about and invested in by so many people. But look how crazy this stock has gotten at times. We have really strong earnings growth here, a real high valuation, and in spite of the strong earnings growth, you had a period of 3 years here where the stock actually lost money. Then it rallies real strong, but then COVID came along. They had to close stores, and the stock price got hit pretty good. But then their earnings rallied, and that created a big rally in the price. But then earnings faltered, and that created a big drop in the price. It's just the same story over and over again. And now we've got pretty cyclical earnings going on, and the company's going through some renovations and a lot of work trying to rebuild the brand and re-get themselves on good footing. But we're not looking at very good results expected for this year. But then hopefully after that, and there are a lot of analysts following the stock, but note that it drops down to only 17 later in the year. So we're looking at Starbucks here. It's been a premiumly valued stock, but boy, the volatility and the risk. There are long periods of time where you could not make any money on the stock. And that's because, almost always because of high valuation. But in more recent years, and when you look at the recent years, it's only been growing at less than 3% a year. That's not so hot, in my opinion. But it is forecast to recover and grow stronger going forward. So Starbucks is a very volatile stock here lately. The next one, we have Smucker. This is just a classic food company. Earnings growth, we did have a special dividend paid. It looks like about $6 or $5 a share in 2009, but it tracked earnings. But again, when valuation got high with a company that's only growing at 6 or 7%, you could look at 4 or 5 years of dead money, although the company has steadily increased their dividend. Right now, because they're undervalued, you're looking at getting almost a 4% yield, 3.8% yield. It's got modest debt. It's BBB rated, investment grade. You've got an earnings yield of almost 9%. And so if I'm looking forward, even though we only got 5% growth, this could lead to strong double-digit, almost 20% a year annualized return. And even at a normal multiple of below 15, you could still make 17 or 18% a year owning Smucker here and get a nice 4% dividend yield that would be expected to grow steadily going into the future. So there you have it. That's today's look at another 30-some stocks in the market that have really showing, I guess we looked at 32 stocks today, and you can see there's all kinds of differences. And even look at the price changes for one day here, how some are making money, some are up, some are down. It is a market of stocks, not a stock market. And it pays to look at stocks through the vision of each individual company more than it does trying to look at the market. Anyway, it's been Chuck Carnevale bringing you part 3 of a 4-part series on dissecting the market and lessons in valuation, where you have all these different reasons why stocks go up and stocks go down over short, long, and intermediate periods of time. I hope you got something out of that. If you liked the video, give me a like, ring the bell so you get access to new videos like this. Subscribe to our YouTube channel if you haven't already, and take a look at subscribing to Fast Graphs. I call it the value investor's best friend. And I think after going through these stocks today, I hope you get a sense of why I say that and why I mean that. Thanks for watching. Talk to you again real soon.